Josh, good to see you.
Yeah, happy Friday.
Happy Friday.
Good to be back in the mix. It's been a couple weeks.
Yep.
I've got
never a dull moment, right?
Yeah, you're not lying. Yeah, 2 weeks gives me too many topics to explore in a day. It gets crazy.
Yeah, and think of what's happened in the last couple of weeks, just in the
Totally.
world and in the markets. Things are moving fast.
Yeah, I have lots in the hopper that I'm hoping to explore with you here in the next 30-ish minutes. A little bit of crypto, a little bit of stocks. I'm maybe even going to look for some emotional guidance or support, but maybe we start with crypto, as I think that week over week causes the most ruckus or noise right now, though inflation and stocks are competing. BitMEX I guess it's probably 10, 15 days ago now, here at the beginning of the month, announced that they are acquiring a 268-year-old German bank. I'm not going to try to pronounce the bank, but it's one of the oldest banks in Europe. I'll make sure that I include the link or I shoot it over to you. And I'm curious, this is the crypto world getting involved in traditional banking, fiat coin. It's kind of interesting to draw that bridge. And I was curious, I don't know if you had any perspective or ideas, or if this, bubbles anything up inside of you as far as what this could do or mean for either side, that traditional banking world, the crypto world. I don't know. Does this do anything for you?
Yeah, I can tell you that as a crypto asset owner, it's frustrating to me that I can't have those crypto assets be part of my financial picture. Right? So I can't go to my bank and say, hey, I own these crypto assets and have that factored into what kind of relationship I can have with the bank and what the bank might be able to do for me, right? So I regard crypto as a core part of my portfolio, along with real estate and along with equities. And I think that a lot of people are increasingly feeling the same way, like these assets deserve a place in our financial lives. And so that's exciting that that integration is at least starting to percolate a little bit. And, I think it's percolating here in the States too. Even bankers are, realizing they're going to get cut out of some action if they can't service their clients who value crypto. So I think it's a step in the right direction. And of course, it's also part of the hype that's going on right now, and probably the inflated assets that some of the crypto, early adopters are enjoying right now.
Yeah, in the back of my mind, I'm hoping that they're going to find some sort of black magic for us, where we can take the DeFi world and the returns that most are seeing over there, the 5%. There's some crazy returns you can get in that market. I'm hoping that we can find a way to blend that with a traditional savings account or the traditional banking system. What we're seeing today, if you put your money in a savings account, it'd be great to bring the DeFi world over there and, I don't know, find some sort of happy medium.
It's going to be a while before that happens, but I do think it's headed in that direction. And I think a big part of it, Josh, is that there's been such a breakdown in trust between the majority of people and the centralized institutions that, are ruling things these days. And there's so much grassroots interest in new paradigms and new solutions that can help us to really have a freer and more innovative society and economy. And so this stuff's just not going away, even if regulators come in and try to whack it, it's going to be whack-a-mole. So meanwhile, there's lots to be careful of. There's tons of scams. This is the Wild West. It's still a ways out before there's real integration, but definitely seeing some steps in the right direction.
Yeah. Speaking of Wild West and sort of just trust breach, another crypto story that I wanted to bring to the table and get your perspective on was this crypto.com breach. And I don't know if you've seen this, but on the 17th, so it's 11-ish days ago, The company tweeted out that all their funds were safe. They shut down trading for a few hours. PeckShield, which is a security research company, goes in, they do a thorough investigation, and then they announced that crypto.com had lost at least 4,600 ETH, which is equivalent to a minimum of $15 million. They're going to continue to do more research. They said that was the floor minimum of what had been lost. I'm not hoping that we take shots at crypto.com. Rather, I'm hoping to get your perspective on the cyber security realm of this. I mean, as we head towards Web3 and crypto and decentralization, you've played in the field. You're one wrong move away from sending your crypto to the wrong wallet and it's gone. There are many accidents. We're taking more control. And I'm curious if, as we take more control, if you have any security concerns or any concerns in that cyber realm.
Holding your own keys is a scary thing. And it's a formidable thing. And it's something that's going to take a lot of education to get people comfortable with. And there will be, service providers who do allow for a level of centralization to make it easier to hold those keys, right? So Coinbase, for example, is very popular holder of keys these days. And they also have a vault where you can, put your keys kind of in deep storage where they can't get taken out for a few days. So if you make a request, then it's a few days before you're even allowed to get those assets out of the vault, and gives time for you to become aware of any issues, et cetera. So this is all part of the learning process. But the beautiful thing about crypto in the end is that, you can self-custody your own keys and you can hold your own assets. So those people that whoever lost, those ETH, they had their keys in some kind of centralized place that they were more vulnerable, right? But, in today's cybersecurity world, you have these huge targets, these huge honeypots that have everybody's data in them, right? And they go in, and if they hack those, they can get 10 million people's information, right? And so with the blockchain and the decentralized model, you actually have, I think, a more broadly secure infrastructure where you don't have these huge, sitting duck targets that if you get into them, you've really done deep damage. So I think overall the cybersecurity model is better in the crypto world, and but it definitely is something that we're still on a learning curve with.
Yeah, totally. There's this may be an interesting bridge to the conversation we were having offline. And yesterday you wrote this piece about the Facebook supercluster and sort of what they have going on and a bit about their vision. I maybe kind of give you the floor here. And I thought it'd be important to give you a couple minutes to unpack your thoughts and where you sit today on this. Could you maybe just share a little bit of, about this?
Yeah, Facebook announced this week, Meta announced this week that they have the 5th largest research supercluster, the 5th fastest supercomputer in the world, and that it's going to be the fastest supercomputer in the world before long, and that they're going to open up new vistas of AI and help build the metaverse based on this new, game-changing artificial intelligence and capabilities. And I think that this is, hey, look, it's impressive, okay? But there's a whole lot of smoke here and not a lot of reality. And I think that long-term, people are really seeing that the data model that exists in big technology today, where you don't control your own data, and they have limited data on you because of this kind of environment of mistrust that we're all living in, where there's kind of this like resource extraction philosophy to data. How do you get data? You trick people into giving it to you, right? And you don't tell them what you're doing, and you get as much as you can without them knowing what's happening. and we don't get to see the algorithms either, right? So that's a model that I don't think is sustainable long-term. And I don't care how big of a supercomputer Facebook has, they're never gonna have the rich data that true game-changing artificial intelligence needs in order to solve real and meaningful problems, okay? And, you know, the online gaming wars between, let's say, you know, Microsoft and Facebook, that's not a real meaningful problem. It may be an economic problem, but it's not a real meaningful problem like helping people solve diabetes, right? Or, hey, how about having a genuinely transparent, open data exchange around COVID? What could have happened if we had had genuine trust between people and institutions that allowed for a secure, free sharing of data where people weren't concerned about their civil liberties and that they actually knew that they owned and controlled their own data, right? So those are the kinds of opportunities that really the technology exists to enable these solutions, these kinds of solutions today. It's certainly coming online. And I just think it's inevitable that when you have those kinds of value opportunities, that they're going to happen. And if the, you know, big tech legacy players don't eventually come around to a model that's called a human-centric data architecture, right, where we own and control our own data and aggregate our own data, and talk about, you know, cybersecurity concerns, right, and keys, right, losing a little crypto is one thing, you know, losing your whole digital identity is a serious thing. And but yet the opportunities are so incredible and really, you know, at hand that this just has to happen. And so I think in the short term, you know, don't be distracted by Meta, what I call Meta Zuck's new supercluster, whatever that might be. But I think we all need to be looking ahead to a new internet architecture that is being developed.
There's you mentioned the gaming war, almost as if you're pulling from my notes. One of the biggest topics that's come up over the last couple of weeks that I wanted to explore with you and see, is this just big companies making moves? Is this a meta move? Is this bigger than that? Was that move by Microsoft that I think you were hinting at earlier? Here in the last weekish, Microsoft bought Activision for $69 billion with a B cash. Microsoft paid 3 times more for a gaming company than they did for LinkedIn in 2016. That's a huge acquisition for Microsoft. And curious, you know, is that a merger and acquisition strategy? Is this just big companies doing what big companies do? Or, you know, in the last few years, they've bought Doom, they've bought Fallout, they've now bought Activision. Are they trying to make a bigger play here and get in bed with Meta?
I think they're absolutely making a bigger play. I think that this was a unique opportunity for them to take advantage of a wounded Activision, and they had the money to do it, and they stepped in and did it. So I think it was a good move for them. I do think it's an economic decision and what to do with their cash. You know, they're actually probably worried about all the cash on their books because they see the inflation writing on the wall too, right? And they were able to acquire a really valuable asset, you know, at a significant discount that they were comfortable with. So I think it was a smart move for them. I think they definitely have their eye on, let's call it the metaverse, although I hate to even use that term these days because, you know, I don't want Zuckerberg to kind of own the term meta, right? And the metaverse, and he's trying to define it as this is like, you know, they're going to create it, and that's not the reality at all. You know, there would be many metaverses. It's been called cyberspace for many decades now. So, you know, the metaverse isn't really a new thing. So, but yes, Microsoft is definitely making a play here for this three-dimensional virtual world that is coming online and is being led by the gaming industry for sure.
I want to ask this, and this is not what this channel's for, so you can tell me to kick rocks, but hot tech stocks is where I want to go next. And so before I get to that question, Microsoft in the last 30 days is down 15%. They make a big play like that. I'm curious if within your technology or within your app, is this a time that feels like, buy when it's down, buy when it's cheap? I mean, Microsoft doesn't seem to be bleeding out of their sides. It seems like they're making power moves here. Maybe it's some sort of investment opportunity.
I think this is typical seasonal weakness in January that we've been seeing. Seasonality is such a powerful force in the markets that almost nobody pays attention to. I mean, not nobody, but plenty of knowledgeable people do. And so this is right in line with typical January action, also right in line with second year of a new president and the cycles that come along with that. So this was not, unpredictable, and also that it was going to be exacerbated by the Fed tapering, by talking about raising rates and slowing down asset purchases, et cetera. So liquidity is drying up. All of that has been very obvious in the markets for anybody who looks at, for example, high yield corporate bonds. Right? They're often what's called the canary in the coal mine, and they've been declining even though S&P 500 and others have been making new highs. So small cap growth stocks have been I think almost 50% of them are down by over 50% now, okay? So there's been signs of liquidity drying up in the markets, and then you have this typical seasonal weakness in late January, as well as kind of the second year of a presidential cycle. So all this stuff is not unexpected. Big question is whether or not this is a buying opportunity right now. I think on the short term it is. Longer term, I do think that we're going through some seismic tectonic changes in terms of the economy right now. And I think it's going to be more volatile. And I think it's not going to be for the faint of heart. And it's certainly not going to be, the straight up market that we saw over the last 18 months. It's going to be a much more nuanced experience.
This is exactly the question that I wanted to sort of build to here with you. This shift in the market, and I told you I was going to ask for some emotional support here. Over the last, since I've been working with you over the last couple of years, we've talked about Cathie Wood, and she's mentioned in your course, she's trackable in your app, her fund, and I'm not picking on her, along with many other hot tech stock funds, are getting beat up at the moment. ARK, her fund, is down 40% as at the beginning of last year. The safer plays, who's known as a safer person, Berkshire Hathaway, is up 30% if you tracked the same time. And it's obviously two very, very different portfolios and holdings. I'm curious if there's anything, the generic question is what's happening, but I wanted to double click on the two different perspectives of those portfolios and see, is there anything that we should be learning from this? Because the market is shifting, and with that, we need to be shifting our investment strategy. What could or should we be learning from those two numbers and how those portfolios have shaken out?
Well, if you take something like Cathie Wood and her ARK fund, she's playing for a 5 to 10 year horizon on disruptive technologies, okay? So one of the biggest pickles we get ourselves into as investors is overcommitting to a position that we don't really understand the time horizon and the volatility. If you think that you're going to buy Cathie ARK's fund just because it's down 50% and that it can't fall another 50%, or same thing with Bitcoin or Ethereum or let alone altcoins, okay? You're getting yourself into an unsustainable emotional position, okay? And so then when this kind of volatility that's totally predictable happens, and we don't know when it's going to happen necessarily, although there were some indications that now was a pretty likely time for it to happen. But this is exactly what you have to be prepared to endure if you are Cathie Wood, or you want to follow Cathie Wood, and you're going to be investing in long-term plays in disruptive technologies. Those can fall 50, 60, 70, 80, 90% and still end up being winners in 5 years. Okay. So it's all about your time horizon, and it's all about your ability to endure the volatility. And that's really what my new financial technology is focused on, is helping people to get a picture of what those realities are for their time horizon and for the amount of money that they've got to put into the markets, right? So when you know that, when the market doesn't, hit you with a curveball because you already knew that curveball, was in the market's pitching repertoire, okay, you are strong hands. Right now, most people are getting thrashed around, scared to death, probably making emotional, reactive decisions because they didn't have realistic expectations of what the market could do, right? And of course, the whole retail financial industry is built around having you have unrealistic expectations about what the market can do for you, how you're going to get rich quick and not have to work, to actually become wealthy and secure your future and your family's future. So anytime somebody's pitching you on a get rich quick scheme, just know, hey, doesn't mean it's necessarily a bad opportunity, but it probably means that, there's a chance of a 90 to 95% correction along the way. So it's all about having accurate expectations. This is actually called risk management. The pros don't live without it. Banks have whole departments of risk management. Where I think the world is going, Josh, is that we're actually all headed towards being our own individual banks. And we need to incorporate risk management, and I even like to call it risk design, okay, into our financial decision-making. That's what any financial institution today does. That's what banks do. And that's really what we're starting to bring to the attention of the public and to make accessible to retail investors, because I do think that the world is headed in this more decentralized, more data rich, more multi-asset, and you can really be your own bank today. And so you might as well have the same tools that banks have to make sure that they understand the risks that they're taking, and that they're making decisions about their collective assets that factor in the relationship between those assets, right? And what that can do for the volatility of their portfolios.
You stole my plug, and so I'll double click on it. And I feel like this is exactly why and where your technology fits in all of this, is understanding where that accepted risk is prior to something like this happening, and knowing what your D score is and what you could expect on any given day. And maybe I just give you a second here to talk about, I'm recording this in January of 2022. The app seems to be in constant development. And so I wanted to just close on that. Do you have any big plans, ideas, capabilities, things in the hopper that you could share with us? Or is it too early to let the cat out of the bag?
Well, we're really working on scalability right now, and the infrastructure, and being able to expand what we've got to multiple timeframes and across multiple assets. So we're just integrating, taking our crypto assets from about 100 cryptos to 6,500 cryptos. So that's an example of an infrastructure scaling, right? To be able to process that and have all that data and build portfolios of cryptos and equities together, look at it on various timeframes, say 3 months, 6 months, 12 months, 24 months. Having all the infrastructure that can do that and can deliver that instantaneously, that's really what's going on behind the scenes right now. And it's coming along a lot faster than it ever has in my experience of building technology. So really excited about that. And also just to make that experience so intuitive for people, the user experience, that's really the key. That this is something that people can relate to. It's not overly complicated. You don't have to have, an MBA in finance to understand it. And when I see people interacting with it, and I see it changing the way they think about investing in an intuitive way, I don't want to get ahead of myself here, but it kind of reminds me of like the original iPhone. right? Like it was just so easy to use, and it opened up a world to people that they hadn't had access for, even to children, So some of that's scary, but on the whole, that was an amazing user experience achievement, right? So we know these tools are valuable. The professional institutions wouldn't be caught dead without them. They're completely absent in the retail conversation because, frankly, they cut against the business revenue models of most of the retail financial service providers. Like, you don't find them in your broker dealers, because if your broker dealer showed you your performance and your risk reward, you wouldn't be transacting as much, you wouldn't have as much churn in your portfolio, and you might not even put more money in until you figured out what you were doing, and they don't really help you do that. So unfortunately, that's the reality of our retail finance landscape today. It's mostly out to take advantage of our behavioral biases, of our financial illiteracy, of our greed, of our wanting to get rich quick, believing that the impossible is possible. And so we can do better than that.
I've used the mess out of the app, as you can imagine. Would happily support a lot of this, a lot of things that you just plugged there, and it's an honor to be a part of it, man. You guys, the app is strapped to a rocket ship, and it feels like every week you mentioned the scalability of this thing it's been impressive, man.
Yeah, and we have a new website now at RiskSmith.com. Just put up a little more information there. We've also started a Discord group that want to build it slow, because important when you're building a community that you really have the community aligned around a mission and a purpose and clarity about it, and not just have it be a free-for-all. But very encouraged about the early engagement that we're seeing, and really looking forward to growing that engagement and growing this community, because it is a new way of seeing the markets, a new way of thinking about our financial lives, and that I think is very aligned with a lot of the sea changes going on in the economy today.
Richard, that's what I had for you, man. I promised you 30 minutes and I'm at my mark. Happy Friday. Again, man, really, really appreciate you allowing me to be a part of this.
Thank you, Josh. You too.